All right, all right, all right. Welcome, traders. Welcome, welcome, welcome. Let me just make sure that this is all set up for your training today. And we are... All right, we're good to go. We are good to go. Let me just make sure that... all right, traders, so fantastic. The live stream is actually working. Fantastic. I'm really, really happy with that. The topic of today's live stream, guys, is going to be the biggest myth that actually stops you with your trading, or stops you in your trading, and has actually stops you from moving forward. So that's what the whole topic about today's session is all about. It's about the things that most people don't see. It's the thing that most people don't see or don't understand about trading that actually is stopping you from moving forward. It's more of a mindset. It's more of a shift that way. And most people don't focus on this, or they don't even understand this sort of thing that I'm talking about. And let me see if I can draw this here. I'm going to type in the biggest myth, MYTH. And so that's what I'm going to be talking to you about, the biggest myth out there. And so what I'm going to be talking to you about is really, really helping you understand about that concept, or about helping you move forward in that way to really, really, really crush it when you're actually looking at the markets there. So that's what I want to talk about in today's session, guys. That's what I want to go through with you today, and I really want to explain that and help you move forward in that way. So that's what I'm going to talk about here, the biggest myth that actually stops you from getting involved in the markets. Let's actually get straight into it right now. Now, the biggest myth that stops you from being involved in the markets or getting ahead of the markets, and this is something that I've struggled with for so long, and every now and then I still struggle with this from time to time to time. Now, what is it? The myth is that more M equals T equals dollars. Now, more trades, so more of trading equals more income, right? So this is one of the biggest things that actually stopped me from moving forward in the markets in a big way, was that I always thought that, okay, if I have more trades, that's going to equal more income in the long run. And I always thought that if I don't have a lot of trades, if I'm not trading all the time, therefore I'm not making money in the long run. So the thing is that when we're one thing I've realized is that having more trades, what you would come across as is that if you or when you're trading the markets, if you have a lot of trades, you're generally going to have a lower win-loss ratio. Makes sense? So the more trades you have, the more active of a trader you are in the markets, the higher the win-loss ratio in the markets. Makes sense? The lower the win-loss ratio. In fact, I just forgot to do something here, guys. Let me do this here from the beginning before I forget. Guys, do not place a trade based on what you see in this session, because trading is risky. It can cause substantial financial loss. There's no guarantees of making money in the markets, and it takes you a long time to become a good trader. So be smart about the way that you're trading the markets. Also, guys, if you haven't grabbed the free trial to my Master Trader Lab monthly membership, and also to grab all these free bonuses as well too for a limited time, as I'm opening up a free trial to the Master Trader Lab. So go to mastertraderlab.com, mastertraderlab.com. All right, there we go. Let's get straight back into the training. So I always thought that more trades equals more income. But one thing I didn't understand when it comes to trading was that that more trades equals generally a lower win-loss ratio. So the more trades that I had, the lower the win-loss ratio there. So we could go down to 60%, 50%, even a 70%, which is still a very good win-loss ratio. I didn't realize that come with it, right? And so when I first started trading, I always wanted to make money on every single trade. right? Keep making money, keep making money, keep making money on every single trade. And there's a 70% win-loss ratio there. But one thing that I for me personally is that if I'm trading a lot in the markets, and I'm trying to get ahead in the markets, one thing that stops me from doing well in the markets, or when I first started trading, was if you're trading a lot and you have a 70% win-loss ratio, then that simply means that you're still going to have 30% of the time you're going to be having losers. And this is something that if you are trading this way, it's not a bad thing. It's just very, very difficult to get ahead. The reason why is because that's a blatant statement, isn't it? More trades equals more income, which is a blatant statement, right? Which is a blatant statement, but which means it's a black and white statement, right? But with a 70% win-loss ratio, you must accept up front that your system can have 2, 3, or even 4 losers in a row, and it be normal. See, I don't know about you, but if I have 2 or 3 or 4 losers in a row, then I'm not feeling very, very confident about my trading. So what do? You start to skip trades, you start to not take trades. And this actually is a snowball effect. It's a very, 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 very big, massive snowball effect that stops you from moving forward there. Again, most people think more trades equals more income, which is the actual opposite, because the more trading you do, the more emotional decisions you're making, the more you're getting in and getting out, you're trying to catch up and so on and so forth. And it's just a snowball from there. So more trades equals more income. That's what I always thought. This here is the biggest myth out there. It's the complete opposite in the markets. What is that? The times that my trading has gotten better and better and better and better over the years. And the reason why is because the number one thing is that I've realized that less trading equals more income. This actually, you actually end up doing a lot of mistakes. You end up going backwards here. So less trading for me equals more income. Now, what is that? The less trading for me equals more income is all about only taking high quality trades. So if I'm trading very, very little, it means I'm not over trading, and I generally have a higher win-loss ratio with not a lot of losses there. So I could actually have like a 90% here, right? Like a 90% win-loss ratio, but not trade a lot. With that win-loss ratio, I'm not going to have very many losses. And with that, it's going to be growing the confidence, and it's going to help me keep going and going and going and going from there. So within your framework, if you're looking at your trading for the next 12 months, ask yourself, like, how are you trading the markets? Are you trading a setup? Yeah, are you trading a setup that has a lot of trades? If so, what's your average win-loss ratio? Right? What is your average win-loss ratio there? Because you need to know that up front. If it's a 70% win-loss ratio, then you must accept up front that you're going to have 2 or 3 or 4 losing rows. It doesn't mean it's a bad thing. It's just this one here has so much more emotions. And for me personally, I overtrade when I start to have a lot of trades. Right, I overtrade when I'm over trading. Right, I'm taking a lot of trades. I'm making a lot of emotional decisions. But when I step back and I don't take a lot of trades, my win-loss ratio goes through the roof. My count continues to grow nicely, and that's how things continue to move forward from there. Makes sense. And this is one of the biggest things that I also talk about in the Master Trader Lab, that you can get there at mastertraderlab.com, the free trial there. I talk about this because it's a very, very, very deep topic that most people don't understand. Is like, this is the framework, this is the mindset, so to speak, of how to get ahead in the markets. Is that for me personally, and you may be different, I don't know, you may be different, where for me personally, I can't trade a lot because I'm a very emotional person. I always do better on trading very little trades, but having the confidence to, as my confidence goes, to put more money on per trade. So therefore, throughout the year, I don't need to have a lot of good trades to trade really well and do really well throughout say 12 months. See, most people want to take a lot of trades because they're starting with a small trading account and they want to make a lot of money from that, and they end up just blowing themselves out of the water. So that is one of the biggest things that stops you from moving forward in the markets, is the myth of more trades equals more income. It actually doesn't. Even if you did have a 70% win-loss ratio, if you have two or three losses in a row, which is normal, guess what? You probably question it. So therefore, you're probably going to stop taking trades. You're not going to be very, very, very consistent. Now, this is a blatant statement here, right? This is wrapped around with the most important part, which is your consistency, discipline, and patience. Consistency, discipline, and patience to only taking those setups. You know, it's not a matter of, well, I took all these trades and these last 10 trades were based on 10 different things. That's not how you get some sort of consistency in the market. Whenever I've done really, really well in the markets, whenever I've done really, really well in the markets, and I continue to do well in the markets, is only when I've waited for what I call my A quality setups there, and it's so critical there. So just remember, guys, this 70% success rate simply means this: you never know, even with the 90% success rate, you never know upfront which trade is going to be a profitable trade and which trade's not going to be a profitable trade. You don't know upfront, right? But people go into the trade hoping and praying that this is going to be a profitable trade. So more trades does not in the long run equal more money. It equals more emotions. It equals you not sticking to the plan properly. It equals you not being patient and jumping in shit that you shouldn't be jumping in. It equals you just being a very, very emotional trader. And even if you did jump in on the right trading setup, now you're very emotional and you may have traded too much to try to catch up. And all this is just a cascading effect through there. Where if this system over here gave me, say, 10 trades per month, which is 120 trades per year, I guarantee you're likely to get blown out of the water with that, because you're not going to stick to the rules 100%. You just won't, right? Trading a lot through there, that's the one. It's never the trading system that gets you. It's your consistency, discipline, and patience. And if you have 2 or 3 losers in a row, I guarantee you're going to end up going backwards and not doing well from that. This is what you don't realize. Now, again, remember your consistency. That's where it starts, with your consistency. Are you taking the same setup again and again and again and again? Or are you just trading based on what you think, hope, or fear? That's not how you get ahead in the markets, guys. Please listen to me. So many people think more trades equals more income. But let me ask you a question. If you had 1 losing trade, would you continue to step up? If you had 2 losing trades, would you continue to step up? If you had 3 losing trades, would you continue to step up? If you had 4 losing trades in a row with that trading system, would you continue to step up? I don't think you would. Because now you're questioning. It's like, I thought this trading system was a good trading system. I thought this was a successful trading system. I thought this worked. It does work. But remember, it doesn't mean that 70%, you can have 3 or 4 losers in a row. You've got to accept that up front. You don't know that. That's where, with me personally, having less trades for me equals more income, because less trades gives me a high win-loss ratio, which ultimately gives me the confidence as I continue to stick to the rules, be consistent, disciplined, and patient with it, gives me the confidence to continue to put more and more and more money on every single trade. See, most people, they don't want to risk a lot of money per trade, or they don't want to put on a bit of money per trade, because they're not confident in their system. And if you're trading a lot, in the markets, firstly, if you're trading a lot, you're going to have a low win-loss ratio. And secondly, if you're just all over the place, getting in here because of this thing here, or getting out here because of this thing here, or doing this because of this thing here, and there's no consistency throughout your trading, no wonder you're not moving forward in your markets. No wonder you're not moving forward in your trading there. The number one biggest thing that has helped me get ahead in the markets has been just looking at all my past trades, even this year, and saying, okay, where have I gone wrong? Have I been very consistent with the trading setup? Is that what I need to do? Do I need to work on being more patient? Do I need to work on being more disciplined and all that sort of stuff? And so that's how, if you want to start to get into the big leagues of how do you have the confidence to start putting on, 50 or 100 grand eventually for you? How do you actually eventually get to that point? I'm not talking about now. I'm talking about like 3 or 4 years down the track. How do you eventually get to that point? It starts with confidence. See, my coach right now, my mentor, he trades multiple six figures per trade, every single trade. And the reason why is because he knows almost every single trade he takes is going to do really well for him. He makes 7 figures per year, but he only trades a few times a month. Now, some months of that's a black and white statement. Some months he will trade a lot because there's a lot of good setups, and some months there's not a lot of trades, and so I guarantee if you're trading a lot, you're making a lot of mistakes and you're only going backwards there. So this is the framework, guys, that most people don't think about when it comes into your longevity in these markets, and it's something that keeps coming back to me again and again and again and again when looking at your trading there. So think about that. Think about, what sort of trading setup are you trading, but also start with that consistency. Are you being consistent at taking that setup? Or is the last 10 trades based on because what you just thought was a good idea because his YouTube video said this, or et cetera, et cetera, et cetera, right? Because that's where you want to start, and that's where you want to be. The most consistent traders are out there are consistent with their trading setup. So let me look at the good old chat box to see what's being on. Stock market to crash, but crypto to explode. Check out. Money makes sense. Well, that's what you think's going to happen. Stock market to crash, and crypto market to explode. That's what they've been saying the entire year. Money makes sense. Dent coin. Yeah. So less is more. Exactly right. Some traders take less than 30 trades a year for 7 figures. Or actually, I know that. I know one person who only trades a few times per year, but he makes a few $1 million per year. Hello, John. Check out GE. What? Let's actually go through this here. So the question I'm getting here right now is, hey, John, check out GE. What do you think about this? Ray Dalio Fund had bought. Oh, I didn't know Ray Dalio Fund had bought it. And I can see the reason why he bought GE. Warren Buffett bought GE, and so did they. But remember, guys, these guys are big traders. They're big pockets. They've got really big pockets. Makes sense. So with that, with that, what you want to do is, let me see if I can do this here. Whoops. Let me go to pop this out. I want to see if I can do this here. All right, cool. All right. Sorry, I'm just going through the questions right now. So based on that GE. So remember, they have deep pockets, right? And Warren Buffett, just because they've been buying it doesn't mean it's the bottom in the markets and so on and so forth. And remember, Ray Dalio, he's been buying gold for the last 3-4 months. Warren Buffett's been buying GE. I'm pretty sure he has. 4 or 5 months ago, he started buying GE. So remember, they have bigger pockets, and remember, they have a long-term view as well too. So then they don't really care what happens over the next 2 or 3 or 4 months. They've got like I reckon a minimum 2-year plan of what's going on. So don't be getting into something because, oh, well, if they're doing it, so I'm going to do it as well too, because, it doesn't mean it's going to go up right now. All I say is focus on the markets and wait for those charts to turn around first. And that's when you start to see some really significant growth out there. Now, I can understand the reason why they're trying to buy GE right now. And that's the reason why. It's because there's been blood on the streets with GE. GE's been absolutely crushed. But it looks like GE is about to see some significant growth out of that there. So 2 trades. So I hope that makes sense there. So yeah, once again, I must repeat myself. Just because these big guys are out there buying the market doesn't mean they're in that it's the bottom of the market right now and it's gonna go up from now and all that sort of stuff, and they know something more than you do and all that sort of stuff. Once again, Ray Dalio has been buying gold for quite some time. It's been going down, for the last 3 or 4 months, a little bit of upward movement for the last couple of months, and so on and so forth. So 2 trades a month can be extremely profitable with proper analysis, in my opinion. Well, it's not a proper analysis. It's not a proper analysis there. It's proper sticking to your plan. It's never about, well, this analysis looks really, really good on this trade, so I'm going to take this. Oh, yeah, damn, that wasn't a good trade. I was wrong. You got to get that right or wrong out of the market. It's about proper sticking to your plan that works almost every single time. See, I know my trading system gives me a 90+% success rate, almost 100% success rate. If I have an A quality setup, even my private clients will tell you that. If you get an A quality setup, almost 100% of the time, it's going to generate a profit. Now, it could be a small profit or it could be a big profit. We don't know. But I'm telling you, almost 100% of the time, it generates a profit on those A quality setups. Is there a lot of those per year? No, there's probably only maybe 1 to 2 dozen per year. But that's all I need. It's not the number of trades, it's the quality. If there are 5 quality trades on a given day that meet your plan, you'd be dumb not to take them, fearing less is more. H1398. That is your black and white statement in there, right? But you say you would be dumb, right? Okay, let's actually put that into practice here. You say that if there's 5 quality trades on that day, what happens if the very first trade you take is a losing trade? What happens if the second trade you take is a losing trade? Now, what are you going to do on that very first? What are you going to do on that third trade now? Are you going to continue to step up? Because you don't know, right? You don't know whether that third trade is going to be a profitable trade or not. Makes sense? Because remember, success rate comes out. The success rate comes out over a basket of trades. It's never about, if you really want to get this win-loss ratio down pack, you need to take a minimum of 30 trades. 30 trades. And because up front, you never know which trade is going to be a profitable trade and which trade is not. So you must accept up front, because again, that's if 5 quality trades doesn't mean it's going to be 5 profitable trades. So, and this is one of the hardest things about trading that most traders have a hard time trading, is they think they know what's going to happen. And so therefore they're trying to make money on every single trade. Remember, up front, especially if you have a lot of trades, you have a low win-loss ratio, you never know up front which trade is going to be part of the loss ratio. If you have a 70% win-loss ratio here, and let me just delete all this off here. If you have a 70% win-loss ratio with your trading system, which is actually a very good 70%, that means 70% of the time are going to be winners and 30% are going to be losers. But if you take this trade right now, just call this one trade, do you know whether it's going to be part of the profitable trade or whether part of the loss in the win-loss ratio? This is the win-loss ratio here. You never know up front. What about this trade here? You'd never know. What about this trade here? You never know. So most traders struggle with the markets because they're trying to be right with the market. They're trying to be right. Meaning, again, that's the reason why for me personally, I can't trade a system that has, a 60 or 70% win-loss ratio. I always get unstuck because I get too emotional about it. Because even I know logically that, okay, I never know up front which trade is going to be part of the 20%, which trade is going to be part of the, the 30%, which is the 30 of the loss ratio, and which trade is going to be part of the 70% with the 70% loss ratio. You never know up front. But to get this win-loss ratio, to really see this win-loss ratio, you need to be consistent, disciplined, and patient, especially consistent on taking that setup every single time, at least for 30 trades in a row. Therefore, you must have very, very good risk management. You must be able to take that trade. And and this is one of the things, is people try to make money on every single trade, especially if you are trading a higher win-loss ratio, a lot of trades and a lower win-loss ratio, 60%, 70%, even an 80%, 20% of the time, you're still going to have losing trades. You can you never know whether this trade is going to be a profitable trade, this trade here, this trade here, this trade. You never know which trade is going to be part of the win in the win-loss ratio and which trade is going to be part of the loss in the loss ratio. And this is where most people get stuck, is they trade a system that has a 7% win-loss ratio and it's a successful system. They take 2 or 3 losing trades in a row and they say this system doesn't work, it sucks, all that sort of stuff. That's where the rubber hits the road there. H1398, I hope you understand now that just because it's a good quality trade doesn't mean it's going to be a profitable trade. And you need to understand your win-loss ratio. That's where, for me, I can't be trading a lot throughout the month. Because if I'm trading a lot, I'm not confident. Is this going to be so on and so forth? But if I'm trading a system where I am right now, where I don't trade a lot, it gives me the confidence to put more and more money on. So I hope that makes sense there. Proper analysis with risk management. A+ setups regards to swing trading, high probability management, in my opinion. Off of us, once again, it's not about getting into just any orders, any sort of. I do agree, sort of, maybe swing trading is, you could call it that, but remember, whenever you're trading, you want to stick to a plan. You want to stick, which simply means a trading setup. That's all it really is, wrapped around with a good entry point, and risk management. That's what a trading plan really is. But if this trade here you take is based on the stochastics, I'm going to put the S, this is the stochastics, and this trade here was based on resistance, and this trade here was based on a YouTube video, there's no consistency out there. No consistency. I would make 2% in profit in the last month if I followed my rules. Fantastic. Are we in a super cycle of 75 to 100 years? I'm not sure what you call that super cycle, but if you understand Ray Dalio stuff, he talks about short-term and long-term debt cycles. We're getting to the point where we're getting to that long-term debt cycle where interest rates are still almost zero, only a few percent, and it's at equilibrium. That's how you know we're getting towards the long-term debt cycle, because they can't, in the past they've been able to raise it to 4 or 5% for it to be some sort of equilibrium. Right now they're just a bit over 2%, and right now what's happening is that it's now hurting asset prices even there. So we're getting almost basically zero, and a few percent off that. And so we're getting towards the long-term debt cycle. What does that mean? It means a complete debt reset that's coming over the next few years. Pensions are gonna be affected. Healthcare is going to be affected. Food stamps, or they basically the same thing over here in Australia. All those things are going to be affected because the government won't be able to assist that anymore, because the long-term debt cycle is all about deleveraging. So all these things are going to be affected. So people, especially the baby boomers that are relying on the government for their funding to live, that's going to be affected over the next say 3 to 4, maybe 5 years, or probably 2 to 4 years. That's going to start to take an effect, because that short-term debt cycle, which is the boom and bust cycle, every say 7 to 10 years, and then the long-term debt cycle, which means every single boom and bust, the government gets in more and more debt every 50 to 75 years. They have to completely deleverage, and this is what happened. This is what happened back at the 1937 level. So that's the reason why 1937, if you go look at it, to 1947, this is when we had basically what you call the lost decade, because there was very little growth. It was very, very painful. And this is what we call like a complete reset in the markets. But then guess what happens? After 10 years, then they start to go through another boom and bust cycle. They start to accumulate more and more debt. And then another 50 years from now, if you're around, you'll see the exact same thing. It's all the cycle. It's all the same thing over and over and over again. But because how you know we're getting towards that long term where all these major things that are funded by the government are going to be affected is that the interest rates can't, let me just go to how you know they're going to be affected is that the interest rates, let me just do this here. Oh, easy, Tiger. What did I do that for? There we go. All right. So how you know we're almost at the long-term debt cycle is, as you know, right, and I'm going to do this green, as the economy's gone boom and bust, boom and bust, boom and bust, so to speak. What's actually happened is, as you know, if you go look at the actual interest rates, you'll notice the interest rates, they may start at 10%, then they drop back down and they come back up to say 7 or 8%. And this here may be 3%. Then they drop back down to 2% and then rally back up to 5%. Then they drop it back down. This is actually 0, what happened recently. And now they just rallied back up here a little bit, maybe 2%, maybe just above 2%. And now guess what? Now that is now above asset prices, which means that is now what you call is now equilibrium, right? So if you look at if you use the line here, you say, okay, this here is when the interest rates are rising. This is when there's equilibrium in the markets before we went through another boom bust cycle. This is now when the equilibrium in the markets, because what is actually happening through this exact same time, and let me actually bring up say a purple line through here. At the exact same time all this is happening, guess what? The governments are getting on more and more and more and more and more and more debt. So the more debt they have, the lower the interest rate can be to create some equilibrium before it starts to hurt them way too much. That's the reason why we start to get this point through here, and this, you can see, couldn't actually get as high as through there. Then this point through here, and this point through here, guys, this point right here, this may be, call this, say, 10%, call this 7%, call this 5%, call this 2%. And so as you can see, the equilibrium, which means where they can raise the interest rates before it starts to hurt asset prices, gets lower and lower and lower. And then that's the reason why you can see right now, this is where we're getting towards the long term of the debt cycle. The long term of the debt cycle simply means we're going to get a complete wash away over the next 10 years. So the next 10 years is going to be very, very, very painful. That's in black and white. That's the reason why it's going to be very, very painful, because the government now needs, over the last since 1947, basically, it started this cycle all over again. And so now it's going to go through. That's the reason why the debt jubilee is in effect, is effect right now, and so on and so forth. Right? It's basically understanding that and going through that. And this is something very, 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 very important for people to understand, is that when you're looking at where the economy is likely to go in the next 10 years, especially in America, this is what's going to happen. Pensions, healthcare, and all that sort of stuff are going to be affected, and possibly, I'm not saying this is going to happen, but possibly another world war, because the last world war came out of the last world war was the 1929 to 1937 level there, and the rise of China and all that sort of stuff as well too, guys. So there's a simplified, and this is the reason why right now, this is the reason why we're actually tipping over in the stock market. So it's pretty much all down from here, guys, in the stock market. That's not a blatant statement across all stocks, by the way. I hope that makes sense for you guys. Let me my trading plan, proper technical analysis, i.e. trading with the trend when a signal enters, established, in my opinion. Cool. We will have a bull run after this crash. Harsh, I hope you understand that what I explained to you there. We may go through another bull run, but looking at this long-term cycle, we're probably going to go through a lot of pain for quite some time before we actually go through another big bull run, because we're getting towards the long term of that debt cycle where the government has just exploded debt, so on and so forth. So if you guys, so there we go, guys. So that's basically it for today's session, guys. Predictions are, I'm not. Oh, okay. Yeah, so just go along with what the market is telling you guys. What the charts are telling you as well too, and basically, I hope you can understand where we are right now in the big cycle of things, and the reason why there's going to be a lot of pain over the next, say, 5 years. It's going to be a lot of pain. Do not be thinking that right now that, oh well, this is just a correction in the stock market, and we're now likely to see another big bull run. Yes, we will see bull runs in stocks. We will see bull runs in stocks. It's probably going to be mining stocks or maybe gold and silver stocks, or same thing, right? It might be some stocks that have been absolutely hammered for the last 2 or 3 years. Maybe like GE may go through a big bull run as everything is starting to collapse and so on and so forth. Makes sense? So there is going to be stocks that are going to go through massive bull runs. It's not a blanket statement across the whole economy, but and that's the reason why you don't want to be bullish or bearish this market. You just want to be trading what you see, which means whenever I trade, like if I right now get a really good quality, like what I call, if I get an A+ setup, that means my trading plan, that means my trading setup, my trading entry, and it's a bullish setup, you better believe I'm taking it. It's just because the S&P 500, the Dow Jones, and all that sort of stuff, the overall market is heading down right now and it's hurting asset prices, doesn't mean we're not going to go through a big bull run in mining stocks. Now, I'm not saying we are, but I'm saying if I get a good bullish setup, I'm going to still take it because it meets my plan. So, guys, with that being said, let me do this here. So with that being said, guys, make sure you go over to mastertraderlab.com to grab your free trial to the Master Trader Lab Monthly, where every month I'll be giving free trainings out to help you with understanding all across the markets, and also to grab all these free bonuses as well too. Mastertraderlab.com for that. All right, guys, thanks for today. Have an amazing day, and I will speak to you next time.